I'm Kay Stice. I've been a business school professor for 35 years and have taught at business schools all around the world. You can learn more about me and about my brother, Jim, at our website, sticelearning.com. If you learned something interesting in this current event video, please remember to like it and subscribe to our channel. On July 1st, 2021, 132 countries agreed to work toward establishing a global minimum corporate tax rate of 15%. This agreement follows 10 years of international negotiations. These 132 countries comprise almost all of the countries in the OECD, the Organization for Economic Cooperation and Development. Almost every country and territory agrees on this initiative. Countries with big economies, such as China, India, the United States, Russia, and Germany, and even countries with small economies, such as Djibouti, Sierra Leone, and Greenland. So what is the underlying motivation for this agreement? Well, we can get a hint from the formal title of the agreement. Statement on a two-pillar solution to address the tax challenges arising from the digitalization of the economy. Now, what, 2 pillars? Pillar 2 is easy to understand, so let's start with it. Pillar 2 involves an international agreement to impose a minimum corporate income tax rate of 15%. For years, some countries have used low income tax rates to lure companies to relocate their businesses. For example, Ireland is famous or infamous for its low corporate tax rate of 12.5%. Microsoft, Apple, and Google have all established operations in Ireland in order to take advantage of those low income tax rates. By the way, Ireland is one of the countries that has not yet signed on to the global minimum corporate tax rate plan. Now, beginning in 2018, U.S. corporate tax rates were lowered from 35% to 21% to make it less attractive for U.S. companies to move their operations overseas. And this kind of tax rate competition works. In 2017, when the U.S. corporate tax rate was 35%, only 1/4 of Microsoft's worldwide income was reported as being generated inside the United States, 1/4. In 2021, after the reduction in U.S. corporate tax rates to 21%, Microsoft reported that 1/2 of its income was generated in the United States. So it appears that lower tax rates are an effective tool for a country to use in luring businesses to relocate. But this encourages a so-called race to the bottom. Country A lowers its income tax rate, so country B responds and lowers its rate, and country A responds and so forth, and in the limit, worldwide corporate income tax rates go to 0. And it has happened. Both the Bahamas and the Cayman Islands have long been famous as corporate tax havens with a corporate income tax rate of 0%. So, Pillar 2 of this OECD document is an agreement among countries not to engage in this race to the bottom, and instead to agree to set their corporate tax rates no lower than 15%. Pillar 1 involves imposing extra income taxes on large, very profitable multinational corporations. Now, whereas Pillar 2, the minimum corporate income tax rate, would apply to hundreds of multinational corporations, Pillar 1 is aimed primarily at just 100 or fewer large multinationals with before-tax profitability of greater than 10%. Now, you want some names? Facebook, Google, Apple, Microsoft, and Intel have been identified as the companies to be impacted most substantially. Notice that these Pillar 1 taxes are triggered by 2 things, one being large and 2 being very profitable on a percentage basis. Now, it's not a coincidence that the companies that have pre-tax profit margins of over 10% are also the companies that have business models based on technology advances, digitized services, and intellectual property. The extra income taxes collected from large multinational corporations under Pillar 1 would be allocated to countries based on the amount of revenue generated from end users in those countries. Now, my opinion, computing and allocating these Pillar 1 surplus income taxes is going to be very challenging and will keep tax lawyers and accountants employed for many years to come. So here's my summary of the 2 pillars of the OECD agreement. Pillar 2 provides a floor of 15% on national corporate income tax rates. Pillar 1 imposes an additional income tax on large, profitable multinational corporations that are generating their profits through technology, digitized services, and intellectual property. Because these international tax rules will involve the transfer of tens of billions of dollars from companies to countries and from one country to another, you can be assured that working out the details will involve lots of heated negotiations. So stay tuned. I hope you enjoyed this current event. Please remember to like this video, share it with a friend who needs to understand what you and I now know, and subscribe to the channel. Thanks.